In our today's video we are going to learn what are the negative impacts of mergers and acquisition on shareholders. So let's go. While mergers and acquisitions, M&A, can have positive impacts, there are also potential negative consequences for shareholders. Here are some of the key negative impacts that shareholders may experience as a result of M&A. 1. Shareholder dilution. Shareholder dilution occurs when a company issues additional shares to finance an acquisition. As a result, existing shareholders' ownership stake in the company is reduced, potentially diminishing their control and influence. This dilution can lead to a decrease in the value of individual shareholders' holdings. 2. Integration challenges and disruptions. Merging two companies can be complex, and integration challenges can arise. Integration efforts may result in disruptions to operations, customer relationships, and employee morale. Delays or difficulties in achieving a successful integration can lead to decreased financial performance and negatively impact shareholder value. 3. Cultural clash and management challenges. Merging organizations often have different cultures, management styles, and processes. The clash of these elements can create challenges in aligning the two entities, affecting decision-making, teamwork, and overall organizational effectiveness. Poorly managed cultural integration can harm shareholder value. 4. Execution and performance risks. M&A deals may not always deliver the anticipated benefits or synergies. Poor execution, integration issues, or unforeseen market conditions can result in underperformance of the merged entity. If the expected financial gains do not materialize, shareholders may experience a decline in the value of their investments. 5. Increased debt and financial risks. M&A transactions often involve the assumption of debt or the issuance of new debt to finance the deal. This increased leverage can introduce financial risks, such as higher interest expense, reduced financial flexibility, and increased vulnerability to economic downturns. If the merged company struggles to manage its debt burden, it can negatively impact shareholder value. 6. Regulatory and legal risks. M&A transactions may face regulatory scrutiny and require approval from antitrust authorities. Delays or challenges in obtaining regulatory approvals can disrupt the transaction and negatively affect shareholder value. Additionally, legal disputes or liabilities arising from the merger can lead to financial losses and legal costs. 7. Market reaction and investor sentiment. The market's reaction to an M&A announcement can be unpredictable. Share prices may experience volatility, and investor sentiment can influence short-term fluctuations. If investors perceive the deal negatively, it can lead to a decline in the share price and shareholder value. It's important for shareholders to carefully evaluate the potential risks and negative impacts associated with an M&A transaction. Conducting thorough due diligence, assessing the strategic rationale, understanding the financial implications, and seeking advice from financial professionals can help shareholders make informed investment decisions.